Hi, all. Tarun, can you confirm if I'm audible?
Yes, sir, you're audible, sir.
Okay, thank you, Tarun. Good morning, everyone. Thank you for joining us today. As Tarun had said, we'll just wait for a couple of more minutes. Around 10:05, we'll start the presentation because people are joining in and we'll give them some time. Thank you.
Hello, all. Lovely morning to one and all. Thank you for joining us today, that too on a Saturday morning. Today's webinar is about our flagship product called Solitaire and where it stands in the curve today. We will have Mr. Ganesh, Associate Vice President PMS, taking you through the presentation. He'll be covering multiple pillars of questions that are of importance and that many seek answers to. So, without wasting any more time, I will pass over the podium to Ganesh.
Thank you, Tarun. Thank you. Good morning, everyone. Thank you for joining us today. And it has been an eventful week for all of us, I think, both on the positive and the negative side. Right. If you look at the positives, Nifty has been hitting all-time highs, and that's where it has closed, ideally close to 21,000. But on the negative side, at least for Chennai people, I think it's been a very hard week to cross. And they say, what, all this only makes us stronger. So hope you all are well and hope your families are safe. So with that, let me start off the presentation. Thank you for joining us today. So Solitaire at market highs, the way ahead. Why we wanted to have this presentation specifically at this point of time is very simple. We've been having a lot of questions, right, from multiple prospective customers or existing clients that, is it a good time? The markets are at the peak. Money's coming through from different forms in liquidities at in abundance in the broader markets today. So, is it really a good time to add more money? So we had broadly thought, these kind of questions can be categorized into three parts specifically, right? Is it the right time? And is it wise to wait for the market correction? And if the market correction comes, what specifically can we offer as a product which is different from the entire industry or entire market as such? So that's what we're going to cover in this presentation. With that, I'll move on to the first question, which is today the right time to invest? See, today, again, every time, so what we usually tell our investors at least is since your investing is going to be very contextual, any day is a good day, right? We would want to substantiate the whole thing throughout this presentation, which will be a mix of behavioral investing, behavior in terms of how investing works and in terms of what Solitaire does to capture this kind of capture opportunities in this kind of a market. If you look at India on a global stance today, what you can see is globally things are not looking very great, right? You can see geopolitical tensions, you can see inflation going up, and global trade is not very easy today. And though the capex momentum, which is expected to continue globally, things are trying to get back on track, and it's not going to be an easy path for them to get back on track. But in contrast, India, if you look at India, the way the balance sheets have been cleaned up in the last 6 years, and the way capacity utilization and infra has been moving up, you can see a lot of good green shoots coming for India, right? See, that is where India is today. India's resilience amidst global turbulence is the title of this L&T. L&T is again a behemoth in India in the construction industry, ideally. So even they believe, or rather, these are the kind of private players which we need to instill confidence from, right? Because they know the ground reality of what is happening, and they definitely see this growth at least on the capex front, or at least on the infra front, staying steady. And obviously, the the ultimate beneficiaries of the same would be us, the people of India, which we are going to realize in the next 10 to 15 years. And this obviously translates to a very, very robust credit growth. See, the economy is in a very sweet spot. You can see that the GST revenue is at its all-time high. And obviously, credit growth, right? Since the balance sheets have been cleaned up, the credit growth is more seamless than what it was before. And all these indicators are uh, pointing towards one. So there is no depth for growth today, though we need to be very careful about valuations, which I will take you through in the next few slides. What in terms of growth, we are in a very, very good place. So if we are able to execute, right now, execution is the key. So the stage is set. We know that India is growing. We have a very healthy middle class population, which is going up the ladder. We have money coming into financial, or rather, we are looking at financialization of India, where more people are investing into the markets, into more financial products. So all these indicators point at one thing, that India definitely is growing. But whether or rather the execution is definitely on our part, on the people of India, how organized, how the movement from unorganized to organized is going to take place in the next 10 to 15 years is going to be very interesting to watch. But again, on the face of it, it looks like India will execute, right? Provided it has a very stable government. Obviously, politically, you can't take a stance and say this is what is going to happen. But then, typically, if the government is going to rule for a period for 10 to 15 years, right, the same government, then we will have a political stability, and markets are obviously going to follow the growth that India is going to offer. And infrastructure growth on a song again. L&T's PPT slide, which we've taken, you can see this is a prime indicator, right? The order inflows that you can see that they are very, very robust. They have grown at a 72% year-on-year growth rate, which is the highest ever for the company. So all this points to definitely one thing: the health, the growth ratios are good, order book is good, all pointing towards one thing, that infrastructure growth and capex growth is on a strong with respect to India. And this is the commentary from major banks, which is Axis Bank. They believe that the Indian story remains strong and intact, and they are seeing a surge in demand. Your banks tell you where the growth comes from. They have a very good view of what where the growth is going to be, because they have the direct access, or the ground reality is more evident to these big banks, which continue to be bullish in India for the foreseeable future. And they believe that the government-led capex cycle is continuing. So as long as we execute and as long as we go on this path and execute it right, then we should not have a problem with growth, is the expectation today. So on the positive side, we're all gung-ho about it. Though on the consumption themes, we have a little bit of weakness today on the rural side as well. Though that should wear out, or rather that should kind of improve in the next few quarters. But that is for everyone to watch. But as far as we are concerned with respect to the infra and capex growth, we are on a song definitely. And Nifty's earnings estimates, right? Nifty's earnings estimates have been pretty much on a like the estimates, which you'll have to look at this slide with the next slide, which is the estimates have been stable. If you look at the expected estimates, right? If you look at 2024 expected estimates, in 2021, the expected estimate was around 917 rupees, which improved to 959. So what similarly with the case of 2025 expected earnings. So what we can see is the way in which EPS was projected 2 years back has actually, and the projection today, the estimates have improved, which means that the from the research, right, or rather the estimation, right, overall the industry believes that India's corporate India can deliver much better today in terms of 2025 earnings estimates. So this reinforces the confidence that corporate India needs to instill in us to make sure that India is on a growth path. And final, this thing is liquidity, right? Net FII inflows is yet to gain steam. So this is the October to November data. This needs to be updated with November. November and December, we had around 13,000 to 15,000 crores of FII inflows as of now, net FII inflows, which is still yet to gain steam. But again, where they pump the money, because large caps as such are looking at a very softer value. I mean, they're softer in terms of valuations today, with small caps and mid caps in select pockets only showing value. We need to be very selective of where we put our money today. But then with respect to FII inflows, they are yet to gain steam, is what we see from this chart. Okay, now we've gone through the first question pretty quickly. That was more about how India's growth story is poised for further growth. And the second question is, again, it's a very big question, right? What is it wise to wait for the markets to correct and then invest? So in the next few slides, what we have are a couple of case studies, right? A couple from the global front, and one from India's market front, to show how futile, market timing could be when you try. So even the biggest investors have actually tried to time the markets and have failed. These kind of the next few slides will show you what exactly that is in numbers, in terms of data. If you look at Bank of America's, they've put out a specific table which actually shows the S&P 500 index's returns over a period of for every 10 years from 1930. So to understand this chart, right, what we need to look at is this price return, which is the first column after the decade, is the returns that the investor would have made in during every decade had he stayed through all the days. I mean, had he stayed invested through all the days in the index. That is between 1920 to 1930, he would have gotten a price return of minus 42%. And for 1930 to 1940, he would have got a price return of 35%. This is for an investor who stayed invested at all points on all days during all the decades, right? So if you look at his returns, right, what effectively has come in this, what effectively he was able to gain during this period from 1930 to 2020, which is 90 years, right? Now, 100 years basically, right? 1920 to 2020. You can look at his returns being 17,715%, which is close to 277 times is what his money has been made into just by staying invested into the markets, right? Now, why is this important? We need to compare this with this. So this price return is the column which an investor would have gained if he had stayed invested throughout. Now, let's say he excludes the best 10 days. That is, let's say he doesn't, he tries to time the market and he pulls out money at one point of time and he misses that or those 10 days, right? The 10 days per decade, that is for 10 years, he is excluding the 10 best days by trying to time the market and missing it. So he's effectively missed those 10 days per decade. So when that happens, right, when you don't get your market timing right, what happens is the returns go from 17,715% to 28%. That is a huge difference, right? You can see that very, very clearly. Obviously, if you had excluded the worst 10 days per decade, his returns would be enormous, which is in the second column, right? But that is hardly possible for most of us, right? It is not easy for us to catch or exclude the worst 10 days per decade very easily. I mean, even the best investors have failed doing it. So let us look at it on the other side. If we exclude the best 10 days by not staying invested during those best 10 days, what do you tend to lose? You tend to lose this huge compounding that you're able to do, and you're left with a meager amount of returns, which is hardly even beating inflation at that point of time. So, what this table and the last column, obviously, it's about excluding the best and worst 10 days. So, you're neither at the bottom or neither at the top, and you're excluding those only. So, even this is going to be a very hard thing for an investor to do, right? And obviously, your returns are going to be a little bit better than your the first column, which is the price return. But again, look at the difference between the first column and the third column. If you miss out these best 10 days for every decade, this is what you end up with. So this tells us repeatedly that market timing is going to be futile no matter whoever you are, no matter how you read the markets, no matter how richly value the markets you feel today are. It is important that you stay invested, right? That is what this shows from the global standpoint. So this is a global, I mean, Bank of America's Bank of America's research that is done, that has come out with this kind of a table. Now let's look at what India's Sensex has given from 1992. So this is a case study again by Ms. Monica Hullen, and this is about India's unluckiest investor, right? So from 1992, if you had invested 1 lakh each year at the Sensex high, right? If you've just invested 1 lakh each year, not 30 lakhs at once, you've invested 1 lakh every year, each year at the Sensex high, which means that from 1992, the Sensex high, let's say it was, let's say around 2000. Beyond that, during that year, the Sensex did not go beyond 2000, right? This happened. If you try to, pull up a case study or calculate what would have happened if you had invested this 1 lakh every year from 1992 to 2022, you would have accumulated an initial investment of 30 lakhs or spread over a period of 30 years. But if you look at the difference, the 30-year average CAGR for this initial investment is around 12%. So just by investing into the highs and staying invested and investing in tranches. So you can see that just 1 lakh, which is the initial investment or the yearly investment that the investor does, it doesn't change over a period of time, it doesn't increase. So even for that investor, the average CAGR is around 12%, right? Now you can see what will happen if you do a little bit more disciplined investing, right? Let's say you try to capture a little bit of a correction in the markets, you try to invest more during a correction, and what is the kind of alpha you would be able to generate, what is the kind of CAGR you'll be able to generate over a period of 30 years is humongous, right? So this typically tells us one thing: even if you invest at the highs, as long as you stay invested for a considerable period of time, you're going to make your money, which is typically the average of what Indian markets have delivered, right? Around 11 to 12% over a period of time. Now, so these questions are there, and there's always this confusion, right? See, we say that the markets are you need to stay invested. You need, because if you put your time in the markets, you're obviously going to get rewarded. So don't time the market, all that. But we also say that make sure that your investing is right, or rather, your deployment needs to be gradual. Why do we say that? That is a kind of a paradox, right? The question that all of us will have right now is, one day you're saying that you have to stay invested, but you're again deploying your money very gradually. How does it? Where's the difference? What is the difference between this and that? Is the question that most of us would have. right? So when so what we have seen in the last 6 months or even 1 year is that people have made money, a lot of money in a lot of specific individual stocks. So when we look at individual stocks, right, when everything has been going up in the last 6 months, we tend to think that this will happen repeatedly in individual stocks, and people have once they taste the once they taste the money, they believe that they can do it in every other stock at any valuation, buying at any price, right? BARP investing doesn't always work, and it does never work, right? So this is from an index point of view. When you do a stock-based or an idea-based investing, it is totally different. This we have a global example. This is a chart that we really like. It is on Walmart Inc., which is one of the biggest companies in the world, right? It's if you look at its 50-year chart, right? So from 1973 to 2000, which is the first 27 years, you can see that the price has appreciated by around 1400 times, right? For a person who invested in 1973, if we had held on with Walmart's stock and if he had kept it till 2000, right, which is 27 years, you can see that his money appreciated by 1400 times. On the contrary, if someone had invested around 2000 or 2001, and today, if you look at the returns that it has delivered, it is less than a CAGR of 2 or 3%, right? Which means, I mean, it's actually doubled only in 23 years. So this is a very stark. I mean, this chart puts a lot of things into perspective because there was nothing. I mean, even today, there is nothing wrong with Walmart, right? Financials are good. It's been growing well. All that has been good, but then it went through a period of time correction and it tested every investor's patience at that point of time, especially those people who bought into Walmart's stock in 2000 or 2001. So they've had a very hard time making money out of the stock, and even in a stock like Walmart, which has been growing pretty decently. So you can see that when you're doing individual stock investing, right, the valuations that you pay for today is going to be very important, right? Though you need to stay invested, though you need to make sure that your investment is very disciplined, though you need to put your time in the markets, and though you need to understand that timing the market won't work, you need to be very aware of valuations when you invest into specific stocks or individual ideas. So this is where we come in, right? So when we look at Walmart or any other idea, what we typically look at is a few things, which I will be taking you through in the next part of the presentation about what Solitaire will do and what Solitaire has done in the past during market highs. So what does Solitaire do at market highs? Uh, okay, the first question that we usually get is how can you find opportunities in market highs? So when we address this question in a very simple manner, that is, when people say markets are high, it's about the broader markets essentially, right? So broader markets are typically a very skewed set of companies which move or break the markets, right? So if Reliance or HDFC Bank or any other top gun in the index moves up or down, it is going to break or make the market accordingly, right? So that is typically what market as such means in the media. So when we look at, or at least when I thought PM is not just Solitaire, I thought PMS looks at investing, it doesn't go top down, or rather it doesn't go through index level investing, right? We look at opportunities in their own right, or we look at opportunities which are out of favor today, and we look at opportunities which are at fair or cheap valuations today, so that we don't go through time corrections like the one we saw in the previous slide. So being so there's no easy answer to where the market will when the market will stop moving up or when the market will find a bottom or any of those questions, because all that is liquidity led. But from a capital allocator perspective, right, what we do is we can let you know where the valuations stand today, and if the valuations are fair, we invest. If the valuations are cheap, we invest more. If the valuations are a little bit expensive or even very rich, we abstain from investing, or we gradually invest into picks which are fairly or cheaply valued. So that is something that I would like to take you through in the next 3 slides about what Solitaire has done in the past when market has touched a high each year. If you look at Nifty 50 today, 8th December 2023, it is obviously close to 21,000 at an all-time high. But let's look at 2021 and 2022 and today 2023 as well. So if you look at 2021, when the Nifty hit its year high, which is 18,477, Solitaire again was posed with a few questions like, the market is high. How are you going to deploy money, and where is it? Is it going to deliver good performance over the next foreseeable future, and all that? So we simply had one answer to those, that though the markets, like I said, there are a set of few stocks which are moving the market up or down. Though the broader markets are richly valued today, we find value, and we only if we find value, we would deploy that money into those specific ideas. So what did we do in 2021 when the client enters? So these are all actual clients who entered in 2021, 18th of October 2021, 1st December 2022, and for a client who enters today, which is 8th December 2023, where our cash levels are. So 18th October 2021, we stayed with 42% cash and around 43% cash in 1st December 2022. So typically the same thing, right? So this tells you one thing. Though the market is going to see, you can see the difference between the cash levels in these years, right? Between 42 and 43, there's not much of a difference. But if you look at our cash levels today, it has gone up by 21%, right? From 2022 to now. So, which says that though the market can be richly valued, the difference between the market going up in 2021 and the market taking a high in 2022 is much different from what a high market has made today. So it is very, very related. So it cannot be just compared like, when the market moves up, they'll probably go to a 60% cash. No, it doesn't work like that. But our investing is very independent of the overall broader markets, and that is where we take a call. When we look at the broader markets today and the overall market as such today, we believe that around 36% from Solitaires perspective is into an investable universe in terms of valuation today, and that is where we stand. So you can see that our investing is extremely customized, extremely entry driven, and based on the valuations of the respective companies that we are looking at the entry of each client. And how did we do from Solitaire portfolios, which started at market highs? These are the returns that we have delivered for a person who started and was also doubtful when they started off at the market highs. 18th October 2021 and 1st December 2022, there has been a good amount of outperformance from our front, right? So what this tells you is, see, it is not that this kind of outperformance are outlier returns, right? So it is very rare that this repeats again and again. But this table just wants to, we just want to give you a sense of what we tend to do even when the markets are at their highs. We tend to find, or rather, we tend to figure out opportunities which intend to deliver better than the overall markets, though it is not our intention. As a consequence to our process, as a consequence to our investing and overall sense of things, we are able to deliver this outperformance. Though these are outlier returns, this is something that we wanted to show you for every client who invested at the market highs in the last 2 years, how their performance is today, right? So this is something that you can take note of, and this is just to show how Solitaire is customized and how it stands out from the broader markets during the highs of broader markets. So with this, we move on to this philosophy of ours, which we repeatedly reiterate time and again with our presentations, that it's great investment is nothing but a mix of strong fundamentals and attractive valuations, right? The reason why we gave 5 points to strong fundamentals and a one significant point to reasonable valuations is you can have the top five, that you can have a good corporate governance, you can have a strong leadership team, which has had a very, very brilliant record of execution, and they can be industry leaders. They can have high growth ratios as well, right? But a prime example of certain companies which have been industry leaders but not been able to generate money for the investors is because they get into these companies at high valuations. And what happens is these companies go through a price correction or a time correction accordingly. If the market, let's say the company doesn't deliver according to the market expectations for a good amount of time, what happens is the market tends to devalue the company in terms of PE or any type in terms of any total valuation that it offers the company. So what happens is it either goes through a price or a time correction, and investors are left without making money for a considerable period of time because they didn't get into the specific company at the right valuations. This again sums up our entire philosophy. Long-term investment success is nothing but riding your winners and selling your losers. Obviously, you're going to have losers in your portfolio and you're going to have winners in your portfolio, but it is upon the Solitaire team to understand to ride the winners and sell your losers. So we have a lot of questions, right? So this company has gone up significantly. Why don't we book profits today? And this was a question that we had even 6 months back, and from then the companies have done even more, right? So what we tend to say to them is, unless the valuations are very, very, very stretched, right, with a specific idea that we have invested in, and we believe that they are far ahead of their intrinsic valuation, only then we take a sell call. Other than that, most of the time, in our experience, what we've followed as a winning formula is to ride our winners and to sell our losers soon, because there are certain companies, right? Let's take the example of an automobile market leader that we got out of recently. And that company, we've been waiting on this. We've been staying invested for more. We stayed invested for more than close to 2 years, right? But in terms of execution, in terms of the intent to execute, they never delivered. So beyond a point, though we made good money out of that company, we came out of it because the management stopped, or rather didn't have the intention to execute further. So the selling losses and riding winners have to be purely in terms of fundamentals, is what we are trying to say, and not just in terms of looking at the price. So if the price is appreciated 2 or 3 times, there is no saying that you'll have to sell those. You'll have to look at valuations and fundamentals from an independent perspective and then take a call on that. And some portfolio quants, as usual, are portfolio of market leaders. So generally, our portfolio consists of market leaders, which take away. I mean, if you look at the top three companies in any industry, right, they take away a huge chunk of the industry profit. So our Solitaire portfolio is it typically consists of these kind of market leaders, which occupy the first, second, or third position. So what you get with these market leaders are these would have managements which have stood the test of time, which would have robust cash flows, and they would have pricing power, so they would be able to handle an inflationary environment better. So all that was something that we have in mind before we ideate a position into a specific company in Solitaire for you. And superior balance sheet metrics. So usually the misconception in the industry is that only if you take a higher risk, you will be able to do higher returns, right? So that's generally the misconception, because most people think, if then it negates the whole point of the risk, right? If you're taking high risk and you will obviously get high returns, then everybody would go for it, right? But then the thing is, what we have observed in the past is how conservative you are with what valuations you pay, and how conservative you are or disciplined you are with your investment can take you much far in terms of returns also, not just in terms of volatility or anything. In terms of returns also, you will be on a very, very great wicket if you tend to follow a very conservative model in terms of investing and the value that you pay for a specific company in your portfolio. What your portfolio typically would look like after a few years is, you will definitely have a few big winners, and most of Solitaire's portfolio picks would be multiple optimum performers who will turn out to become big winners with time being given to that company to perform in terms of price in the portfolio. And obviously, as the law of probability says, you will have a few losers as well. It is up to us to make sure that we avoid the losers as much as possible. But certain things are inevitable. We can go wrong. The market can, or rather, the company need not execute the way we think it would execute. So anything can happen, right? It's some of probabilities that we are looking at over here. And typically, we've done well in the past, and the intention to do better is always there. So that should be done in the future as well. And the Solitaire's positioning currently is again a mix of these three, right? We are looking at India's financialization story becoming big. You can see multiple people coming into the markets. You can see, that this picture depicts it very clearly, right? You can see a goddess idol I mean, the idol has a Paytm QR code, and instead of putting your money in the undial, it's directly goes in the form of digital money to the temple. So everyone is embracing, even God is embracing digital and financialization today. So this is something which is going to be turning out to be which will turn out to be a much bigger thing than what it is today in India over the next 10 to 15 years. And we are in a very, very sweet spot with respect to growth and with respect to how we execute this financialization story in the next decade. So it's going to be very interesting. And this is going to be with a combination of, so this is overall India's growing, right? But where do we stand out? Where Solitaire's current positioning stands out, it wants to be part of, or rather, it wants to have efficient players who are becoming world champions, essentially, right? These are companies which can be small today or which can be big, which can turn out to be bigger tomorrow, right? See, these kind of companies are efficient and conservative, and they're on their way to becoming world champions. So those are the companies that we typically look forward to buying in your portfolio. And obviously, Make in India is something that obviously all of us know is working very well with respect to manufacturing with China. We are so one portion of China coming into India, and the overall global focus on manufacturing is on India. I think we are going to see good times in the future as well. The risk positioning, as we always say, it's a moderate risk-taking portfolio in terms of Solitaire, and the return expectation is around 700 to 900 bips over the average inflation. So what we typically tell our clients is, see, come with a decent expectation. Markets have been very, very favorable in the last couple of years. We've done well, definitely. So we need to definitely, be happy about what we have made in the last few years. But again, what markets have delivered in the past over a considerable period of time is around 11 to 12%, right? So our intention is to do better. And our intention is to make sure that we do it with a moderate risk that we usually take, because capital protection is of utmost importance to us. So our investors need to have a very decent expectation, or very good, or the expectations need not be as aggressive as it is today, because the markets are definitely euphoric. Money is coming in left, right, and center into mutual funds, into generally into the market, definitely, right? So people are definitely gung ho about where markets will go, but it is important to know where we are and what we have done in the past, and to set our expectations right. The conclusion is the opportunity ahead on the Indian economy, which is good, and the corporate India prospects long term definitely good, and valuations. This is a very, very key point. It is attractive in select pockets today, right? There are very, very few. So today you can see money coming into small caps and mid caps on a heavy. On a heavy basis, right? Mutual funds are buying, retail investors are buying. So you can see a lot of money being thrown into small caps. So today in small caps, we believe it's a very, very tricky space today, right? You have to be extremely selective with respect to small caps. It is not how it was, let's say, in 2021 or even 6 or 8 months back. So you have to be extremely selective. If not, small caps can cause definitely a huge turmoil in your portfolio. So generally, we have also been asked questions recently why we have been investing only so much into the why do we have so much cash into the portfolio? And these are the questions that is natural for every investor, right? Because you've seen markets going up in the last couple of weeks. So if we are not completely 100% invested, we wouldn't be performing as much as the market in the last 2 weeks. So the reason why we believe that today our investing has to be more gradual than it was 1 or 2 years back, or even 6 months back, is because valuations are definitely not very lucrative. It is attractive in terms of large cap names, but in small caps and mid caps, we'll have to be extremely, extremely selective today. And which is why we are extremely careful, because whatever the market gives, right, when it gives you an up move, or when it gives you money like that in a very, very quick scheme of things, in a shorter time frame, it has the tendency to take it all back very, very soon. So we are very careful with where we deploy money today in small caps. And large caps, we are typically pretty bullish in terms of valuations. And again, over there also, we need to be extremely selective, and we can't be investing into every other large cap out there. So attractive in selective pockets, specifically into small caps and mid caps today, is the final conclusion that you can take away from this presentation. And Solitaire or Riddhi or True or Sphere, any product of ours will have that in mind before investing your money into it. And this is Solitaire's performance as of 30th of November 2023. We've done well. Again, this again, this needs to be looked at it from a context of peak valuations in the market, and we've been able to deliver bigger alpha than the market. So definitely there is merit in our investing. There's no doubt about it. But again, we need to keep our expectations very, very decent, especially today, because markets are not cheap today. And obviously, there is going to be a if there is going to be an expectation of these kind of returns being very sustainable, these kind of returns being sustainable over a period of a long time, that's definitely not sustainable, right? We need to keep our expectations set and decent and travel that path by looking at data, because data doesn't lie. Things people can lie. You can say that I will be able to generate this, I'll be able to generate that by showing the performance, but the past data doesn't lie. So let's be extremely decent with our expectations, especially today. And we have our team, Mr. Sham, who's at the top, and we have a fund management team, Mr. Balaji, Rohit, Rajat, and Mr. Niranjan. And Balaji heads the research team. Rohit and Rajat are the co-fund managers for our small cap product Rudy, and Mr. Niranjan heads the Sphere team. We have a research and strategy team, investment and product. So what we again and again say is that we are a team. It's a very robust process that we follow with our investing, and we take our jobs very, very seriously, and because it's people's money that we are handling ultimately. And for that, we believe that it's a very virtuous job to have, because as a person or as investors come to us and give their money, it's their hard-earned money that we need to take care of, and we have a big social responsibility towards it, and which is why there's a very, very robust process behind this team, and every one of us is working to achieve what we promise that we achieve. So we want. So the thing is, when people come and ask us, right, will you get the best returns out of the industry? We say we will never give you that promise, because we don't intend to give you the best returns in the industry. I mean, as a consequence, we can become the best performers in the industry, but nobody knows. We don't intend to do that. Our intention is to not mismanage your money. So that kind of a promise that you can definitely take from the team. And Mr. Sham Shekhar's profile, obviously, he has 3 decades of investing experience in high growth businesses. So he's seen multiple cycles, and his philosophy that is flowing down to all of us. So typically, we've always asked. So some of us keep asking, right? Whatever you guys say is exactly what Sham also says. So that is what we tell them, right? It's his philosophy just flowing down, and every one of us says the same thing because we believe the same thing, and there is a merit to it, because the experience comes with a multiple looking at multiple cycles and economic contexts, essentially. And these are the key terms of Solitaire. It's a PMS, so it has the SEBI mandate of 50 lakhs, which is the minimum investment amount, and the fees, exit load, and exposures and asset allocation is for your viewing. So maybe we'll spend a minute over here before we move on to the question and answer session. So this is the disclaimer. So all this information that we shared in this are purely educational in nature. There's no advice or suggestion on any individual stocks. If there are any individual stocks which have been named in the presentation, it should not be considered as advice, right? So we'll move on to the question and answer session. Tarun, we can do that, right?
Yes, sir.
Thank you. So if you have any questions, you can type them out in the chat box, and I'll be happy to answer them. Thank you. So the chat box button is on the first question. Sorry, I was on mute. Sorry. So this is a question that we've been getting from Mr. Sriram Gopalakrishna's first question for a new client joining today with 5 years horizon. Do you recommend Solitaire or Vriddhi? This again is a question we've been getting recently a lot of from a lot of our existing clients and prospects as well. We typically say one thing, right? They intend to serve different purposes. Solitaire intends to serve a different purpose, and Vriddhi intends to serve a different purpose, and for a different type of money. So a person can definitely have both Solitaire and Vriddhi if the money intended for a specific requirement is different. Which is to say, you can have a Solitaire is a moderate risk taking product. It's for a person who has a or a money which is intended for a moderate risk appetite taking thing. And for Vriddhi, it's a little bit more aggressive. And for a person in terms of if they have the risk, if they have the risk appetite to take a little bit more aggression in their portfolio, Vriddhi is a great product for you to have. And if you have the 5 years horizon or even more, that would be better because small caps generally take a good gestation period for them to perform, and your time in the markets with respect to small caps will definitely have a huge bearing on the returns that it can deliver. So for a person with that in mind, with who's okay with that kind of an aggression, definitely can go for Vriddhi. With respect to Solitaire, the investing will be a little bit more broad based. It's a multi-cap fund, so the risk taking will also be a little bit moderate, and it's extremely risk the returns that you see will be extremely risk adjusted. And if you do not require that kind of ups and downs, those kind of, because we can say, I will be a long term investor, I can see drawdowns of 50% in the portfolio at any point of time. All that you can say, but then when it actually happens, right? Let's say you start with the 50 lakh and it goes to 25 lakhs, will you be able to take it even for a minute or two is the question. So if that is the kind of stomach that you have, then you can go for a Vriddhi product. But if it's something that I'll be okay with a little bit more reasonable returns, and I wouldn't want to go very fast on the even if it's on the highway, even I wouldn't want to go beyond 80. If you believe in that kind of an approach, then you can definitely go for Solitaire. Hope that answers your question, sir. The next question from Mr. Karthik Chandramohan. Can you talk about the drawdowns in the PMS during bear period? Yes, sir. So we have so these are specific data points that we would love to give you, and this needs to be taken outside the presentation. So what I'll do is I'll ask one of our representatives to give you a call and take you through on what exactly this has happened. If this was a part of the presentation, I would be able to show you it right now. But then this involves data, so we will take it outside this presentation, and then we will ask the representative to make it clear about how we behaved with respect to Solitaire or any other product for that matter during a drawdown period. Hope that answers your question, sir. Okay. Question from Mr. Nyanchand. What is your investment process when you're zeroing in on an investment idea? Okay. So typically what we look for are market leaders. So, right, see, market leaders, again, it's going to be very, very selective. These are going to be from industries which do not have a lot of things going favorable to them today. Because chances are that if you want to buy a company which is a market leader in an industry which is very hot today, you wouldn't probably get them at a good valuation or a fair valuation. Market would always price it in, would have priced it in by now. So with that in perspective, we look at market leaders in any industry into an industry which is going through a temporary bad phase, probably, right? And once this temporary bad phase gets over, the money, obviously, or rather the growth, the impending growth that is going to come to is going to flow into these market leaders only. And once we establish this market leadership pipe, investment pipe of our Solitaire or Vidhi or True Blue for that matter, or Sphere, what we zero in are those companies which have good managements, right? See, obviously, if you're a market leader, you should have your managements. The assumption is that your managements need to be top notch or high quality, but that sometimes is not the case because we've seen managements at the top and companies which have been called blue chip companies and their managements who are supposed to be top notch management, it's making wrong calls, right? So we typically take that very seriously because certain things you can put on paper. You can say quantitatively this is going to grow this much, this is going to grow that much. But then qualitatively, if you look at, very few tend to execute what they promise. So execution history and conservatism is something that we definitely look at before zeroing in a management quality, or rather zeroing in into a company for its management quality. And we obviously would have, the company needs to have a very clean balance sheet, that it should not. So some companies will have a lot of debt in their books, and the way they service their debt also would be very dicey. So we completely avoid those companies typically. So a clean balance sheet, top-notch management, and good growth ratios, and with in a sector or in a phase which is going through a temporary back period with good valuations. So that is the final nail in the coffin kind of a thing, right? You need to make sure that you tick this all, and then if you forget to look at valuations, then you're going to be in for a time correction or a price correction for a considerable period of time without making money for your investor. So this typically looks, this is what we do before we zero in into an investment idea in Solitaire or with the or any other product. Question from Mr. Chandu. There's a lot of money going into the IPOs. We've seen this move. We before in ithought assessment, 90% IPOs are losing proposition. Uh, So we wouldn't be able to. Today, as you rightly said, sir, there's a lot of money going into IPOs today, and market typically is very gung ho about any idea that is put forth in front of them. That's why you can see a lot of companies going for IPOs today, and for promoter to time their exits. Right? We've seen this before, like you rightly said. So whether this number, which is 90% plus or minus, are not, so we can't give that kind of a number, or we can't put a number to it. But then you can definitely sense a lot of euphoria today in IPOs. There's definitely there's not, that's something that you can definitely not deny. So we have to be extremely selective, and typically we don't invest in IPOs because we would want the company to raise money, or rather to raise money in public first, and then once it trades, you can see a lot of information coming out, which is mandated, because as long as it's private, it does not need to disclose certain information. As long as it becomes listed, it has to go through certain regulations in terms of disclosures that we will take a look at before investing into a specific idea. So we would wait for that company to spend a good amount of time in the public markets before zeroing in on an idea. So we never invest in IPOs, definitely. And question from Mr. Dinesh, for someone who entered a year back, what is the time frame to complete the whole deployment of 50 lakhs? Sir, it depends. See, for the entered a year back, it can be around 3 months is what we would have taken to complete this entire 50 lakhs. Because if you look at a year back, you can say you could have entered even during March 2023, where definitely we were very we found, or we were able to get stocks at very cheap valuations at that point of time. So let's say you had started in December, March would have immediately come, and within 3 months we would have almost deployed all your money, because that's where the valuations were. For those clients, we've done extremely well, obviously, because markets gave that opportunity for us to buy those stocks at those valuations at that point of time. But again, it's going to be varying, right? It's not so. Let's say 2019, you had come immediately, 2020 happened. Then at that point of time, we can't have 20% or 30% cash, right? We need to be fully invested during a period like 2020. So it's going to be very, very customized according to the date of entry of each investor. So at that point of time, it would have typically taken 3 months. So hope that answers your question. Question from Mr. Kannan, please share you're offering only PMS or any mutual fund advice. So as far as ithought is concerned, we're offering PMS and financial planning services. With respect to mutual fund advice, it's we have a sister concern which who's a mutual fund distributor. So we can ask one of our representatives to get in touch with you with respect to that, and you can take it forward if you're interested. Hope that answers your question, sir. Question from Lakshmi Shanmugam. How many years is the best to stay invested in the market? Because sometimes when we stay for more than 5 years, the returns is comparatively less than what we get in 5 years. Okay. Yes, ma'am. So sometimes what happens is, like we had seen in one of those slides, right? The Walmart slide. If you had gotten into Walmart after 2001, right, or on to at 2000 or 2001, even if you had been invested in Walmart for 5 years, you have not made any money, correct? So that is the right question to ask, which is why we say it is extremely important to be selective while you invest into specific stocks. See, index investing is different and specific stock investing is very different. Today, what we see in the market is specific stock investing is considered to be very easy because people have made money left, right, and center in any stock that they've invested in. So you need to be extremely selective today because this is a prime case of euphoria, and you see this happening time and again, right? So what the best strategy would be to look at valuations and look at where the company intends to grow in the next few years, at least in the medium term, that is 2 to 3 years, and then take a call, man. So if you stay invested, obviously staying invested is going to give you better returns when compared to churning your portfolio again and again, right? That we've seen because that kind of process only works, right? So we've seen that with our experience. But if you stay invested in the wrong stock, obviously you're not going to make money. So it is about the strategy. Strategy of following a specific. So you can have your financial advisor let you know what to buy and what to. So which is what we typically do, right? Which is something that we do is our bread and butter. So your core activity might be something else, while choosing a stock might be not be your core competence. So which is why we say, this is something which is our bread and butter, which we are able to do better because of the time that we have more than you to allocate to this. So, when to the best strategy would be to make sure that you enter into the right picks and stay invested and keep a strong vigil on all these ideas that you invest in. So, hope that answers your question. Question from Mr. Vignesh M. The index chart looks good when looked at 30 years, 1992 to 2023. But is that the same case between 92 to 2000? Or even going further, what is the probability of Great Depression like 1929 or a Japanese bubble? Yes. So, Vignesh, what we see is the same thing, right? In that slide, also, if you looked at between 1992 to 2023, obviously the CAGR is 12%, but if you had checked the slide, we've also mentioned, let me go back to the slide so that it's better for you to revisit. It's uh, it's the number of years that the portfolio was down by more than 50%. It's for two times this has happened between 1992 to 2023. So which is what we typically say, right? So when you invest, right, even when you invest mindlessly in the index, this is something that you tend to generate by staying just invested. So the probability of a Great Depression like 1929 or a Japanese bubble is not something that you can expect at least now, right? As far as the data that we have with us today, we don't see that kind of a bubble coming up. But the thing is, obviously, markets will go through price correction because the tendency, though the market's tendency is to go up, obviously it can't keep going up. It is going to correct and it is going to give us opportunities. But it is anybody's guess when it is going to correct or when it is going to give us opportunities. But the thing is, staying invested is definitely going to be more beneficial because you can see that the most unluckiest investors have still been able to generate a CAGR of 12% over a period of 30 years, despite looking at his portfolio go down by 50%, more than 50% twice between these 30 years. So the reason, so you need to have this kind of an approach or a discipline to stay invested in the market and keep investing when the chips are down. And obviously, we've seen in our experience that it has turned out to be good. Hope that answers your question. Question from Mr. Kiruba. If client comes with you a fully invested portfolio of 50 lakhs, what process will be followed to convert his portfolio to Solitaire? Yes, sir, you can share your portfolio with us, and we'll let you know what you can avoid, or rather how you can carve a portfolio out for 50 lakhs from that to move into Solitaire, and we can take it forward accordingly, sir. So it will be more of a review from our end. So once that is completed with one of our relationship managers, you can move that money to Solitaire and we can start afresh. Question from Mr. Kotian Purushottam. Your view on large cap insurance companies. Insurance, we are definitely bullish, sir. So large caps definitely, like I said, they are looking a little bit softer in terms of valuation than mid and small caps. So we are bullish. We should be doing well. Question from Mr. Vignesh M. What is the portfolio of this PMS? Okay, the question, what is the portfolio? We don't, okay, we don't disclose the portfolio. So we don't have a model portfolio approach at all. So which is what we typically say, right? Whenever you come in, your portfolio is going to be customized according to your date of entry, and there's no model portfolio approach because we intend to give a pretty much a homogeneous experience to all our clients, because one client can come and let's say a client who comes in 2020 and the client who comes in today, we do not want them to have a very diverse or a different experience. Okay, so which is why we curate a portfolio according to the date of entry of each investor, and which is why our investment universe also is a little bit smaller today because of the valuations that is prevailing in the market, and our deployment is also according to that. So we, like I said, we deploy only 35-36% today, and 64% is kept in cash. So it is going to be an entirely new portfolio than a person who came into the system 6 months or even 1 year back, right? So there's no model portfolio approach, if that is the question that you had asked. It's going to be customized according to the date of entry of each investor, and we don't release the model portfolio also. So since it's client data, it's private, owing to the privacy of each client portfolios, we don't release the portfolios as such. So hope that answers your question. Question from Mr. Ganesh: what is the highest difference between the returns in the entire Solitaire portfolio when compared with the least returns of an individual portfolio over a 1 year time frame? Okay. So, okay, this again is going to be a number driven. So, though I do not want to give you any specific number here, we can always work it out and let our relationship manager and relationship managers explain what it is and give you the exact number. We could tell you that the returns are pretty much, or rather, the experience will be pretty much homogeneous, right? When compared to the least returns of an individual portfolio over a 1 year time frame. Okay, so if they had onboarded at the same time, and we usually have this practice in Solitaire or any other product in our PMS, that we ask for additional corpus whenever the chips are down. Whenever we believe that valuations are more lucrative comparatively in the stocks that we are looking at to add new portfolio, right? So we typically urge our investors to add little bits, let's say 5% or a 10% whenever the opportunities come. As advisors, it's our duty to come let you know of it. At that point of time, the investors can participate if they have liquidity. So all this put together, there's a each investor's portfolio will be built differently over a period of 1 year. So we can definitely give you the highest difference between the returns of the entire Solitaire portfolio and between the with the least returns. But we typically believe that it's pretty much going to be homogeneous. Though I don't want to give you a number, we can always get to it after this call. We can ask one of our relationship managers to get in touch with you to give you the exact number. So hope that question answers. I mean, hope that answer to your question. Again, a question from Mr. Dinesh: how long period can you keep the money as cash as the current valuation is high? Any limitation in timeline to keep the cash? No, sir. So that is something, that is the flexibility that we have in the PMS. So there's no compulsion for us to, outperform an index, or keep the money invested not keep the cash for a very long time. So that is the flexibility in terms of structure that we have for a PMS. So we can keep the cash as long as we want, as long as the valuations are not supportive, we wouldn't be investing, right? That is a call that we would strongly take, and we have that flexibility in the PMS structure essentially. Do you keep the cash in debt segment or somewhere else? Is there any return that can be expected during the money kept as cash? Yes, sir. So cash, essentially, if we don't foresee another deployment in the next couple of days, right? Let's say on a day-to-day basis, we assess the situations in the market and valuations in the market. So we tend to keep around 5 to 6% as just cash. And so let's say in this 36% that, or rather 100% that is being invested today, 36% would be invested into equity, 5% would be just cash, and the remaining 60% will be into debt securities or ETFs, liquid B's ETFs essentially, which will probably yield you a common savings bank yield that you would be able to get. So you can expect a few returns in that investment as well. 14 Purushottam. Thank you, sir. Thank you, Mr. Kripa. And question from Mr. Sriram: when an existing client wants to add an incremental amount, how should the Solitaire portfolio be valued? Okay. Okay. So this is an interesting question. See, for an existing client, they want to add an incremental amount, right? Like I had said, we have no model portfolio approach. So it is not like you're investing 50 lakhs today in a portfolio, and then tomorrow, let's say you invest an additional contribution of 5 lakhs. It doesn't go into the same set of stocks tomorrow as well. It goes into a specific set of 2 or 3 stocks or 4 stocks, which we believe are at better valuations than what they were at better valuations today, and which is why we would have requested the money. So we wouldn't have requested money for the entire portfolio or adding to the entire stock universe of the portfolio. We would ask money to add to a specific set of ideas which are looking better than the rest. So when that happens, right, the money goes into those specific ideas. So there's no, so the NAV concept doesn't come into the picture in this case, because it is client level investing that we are doing, and not fund level investing that we are typically doing. So when you add as an existing client, you might add today, another client might add 1 week later. So at that point of time, the valuations for that we were looking at to add at that point of time may not be available completely. So if we had asked money for 4 stocks, if the 4 stocks have delivered, have gone up at that point of time, we wouldn't be able to buy for the next client who gives the money next week. So we would be buying, let's say, 2 stocks which are looking better at that point of time. So it's going to be very, very structured. It's going to be very customized according to each cash flow that gets in, not only the initial investment, but each cash flow that you're going to add, right? It's going to have a very customized investing that is going to take place in your portfolio. So that is how it is going to be done, and not just random investing across all stocks, which will typically dilute your returns over the long term. So this is something that we've been following right from day one, and we intend to do that. And we believe that is our USP essentially, and which is why we are able to sit where we are today. So that's a prime reason why we've been giving the kind of experience that we've been giving to all our investors. And from Mr. Bhaskar, so it's a kind of private portfolio for each person. Exactly, sir. It's a private portfolio for each person, definitely. So it's like uh, the fund, uh, the fund performance or whatever you see, right? It's only a consequence of multiple investors' returns put together, performance put together. That's how we look at it, right? Because our focus is completely on each client's returns, and that is something that we track on a very, very frequent basis. Because you can see that certain funds, if you look at the overall fund structure, right? In the industry, you can see that the average returns they would have made, but then the difference in returns, or the experience for different investors, it would be vastly different from the average returns that is generated on the overall level. So we try to avoid that, and the way we can avoid it from our level is to invest only when the valuations are giving us that favorability. So we invest privately, like you rightly said, it's a private portfolio for each person, and then all that put together into a fund which is coming to Solitaire, because we track. So none of us actually know what the returns are. I mean, like let's say our fund managers, right? They don't look at the fund's performance on a daily basis. That's usually the practice in the industry, right? How much of this performance has influenced the overall fund, which is what we can show outside. So that is not something that we do. Our fund managers look at client portfolios on a daily basis and see if we have performed for each client. So that is where we differ. Hope that answered your question, sir. Thank you, sir. Any other questions? Thank you, sir. Thank you, Kanan. Any other questions? If you have any questions, you can type them out in the chat box. So the chat button is on the top left, close to the timer that you can see on the screen. We'll just wait for a minute or so. If there are no questions, we can close it. That'll be okay, right, Tarun?
Yes, sir. Yes, sir.
Okay. Thank you. Thank you, Mr. Gishma. Thank you so much. Okay. Question from Mr. Bhaskar. Please ask Sham sir to put one video series about PMS, like when retail investor or small needs to move from index to PMS. Definitely, so I'll pass it on to uh, Sham, and we'll take it out. We'll give out a video soon enough on the same. Thank you. Okay, so if there are no other questions, we can end the session. You can look at our contact details on the screen, which is our email ID and our website and our phone number. You can contact us, and one of our representatives will get in touch with you to take you forward with any questions that you've had during this presentation. So there were a few questions which involved a little bit of, I mean, in terms of numbers, we had to be a little bit clear with respect to those answering to those questions. So if those questions could be redirected towards this number, you can contact us, and if our representatives, once they get in touch with you, they will be able to get the data from our team and give it to you firsthand, right? So we can take it forward from there. So thank you all for coming today. And since it's a Saturday morning and we've just, at least Chennai, we're coming out of a tough week. So thank you for taking the time to listen to us, and please visit. I think we have another webinar coming up today. So if you guys are free, please do attend that as well. So thank you, thank you, thank you so much.